So we are looking at accounting for assets and liability, and this is financial reporting. And these are one of the vital topics that carries between 25 to 30 marks or 35 marks in your exams. And I want us to start with investment property, that's under IAS 40. And these are assets held to earn rentals or for capital acquisition, or for both, rather than used in the production or rather than used in the normal day-to-day operation. That's what we call an investment property. If you hold an asset, for example, if you buy a land, you're not using that land on a day-to-day operation. You're just holding that property or that land for capital appreciation. You're waiting the value of that land to appreciate. So that's what we call now an investment property. Now, if you're using that land or that building on a day-to-day operation, therefore it's not an investment property, and therefore it goes to the part of plant property and equipment. But investment property are strictly just held to earn rentals or for capital acquisition, e.g. land and buildings. Then we have examples of investment property, which include land held for long-term capital acquisition rather than short-term sale in the ordinary course of the business. Also, we have land held for predetermined future use, a building owned by entity or held under finances by the entity and leased out. Also, a building which is vacant but is held to be leased under one or more operating lease, or property that is being constructed for future use as an investment property. Then we have property which are not considered to be investment property. One being land held for ordinary use by the entity, that day-to-day operation. Also, building held for use rather than capital acquisition or to earn rentals. Then asset held for normal use. We have asset held for normal use or production of goods and services. So now, how do we measure investment property? Now, investment property initially or under initial measurement, the investment property shall be measured at cost. So measure them at cost. If you go around at 100 million, that's what you recognize in your financial statement. Now, cost shall include the purchase price and any other direct attributable cost incurred on acquisition of investment property. Then subsequently, how do we measure it subsequently? Now, subsequently, you can either use cost model, or you can also determine to use the fair value. And fair value just simply means the market value. So the entity shall choose either to use of the cost model or the fair value model. And what are the recognition criteria for investment property? Now, investment property should be recognized as an asset, and this is applicable to all assets. An asset should be recognized, number one, when it's probable that the future economic benefit will flow from that asset. Number two, the cost or fair value of the investment property can be measured reliably. And then when the entity controls the investment property. Good. Then let's look at property, plant, and equipment. That's PPE. That's under IAS 16. And IAS 16, that's PPE, outlines the accounting treatment of most type of PPE items. It further stipulates the principle of recognizing PPE as an asset. So PPE are initially recognized at cost, and subsequently you can either use the cost or the revalued model or the fair value model. So initially you measure them at cost, subsequently you measure them either at cost or revalued model. And what are some of the disclosure requirements for PPE? Now, the following information should be presented in respect of items of plant, property, and equipment. One, the basis of measuring the carrying amount. Carrying amount is the amount in which an item is shown or presented in the financial statement. Then number two is the depreciation method used, that is rate. So we say that you have a straight-line method, you also have a reducing balance method, you have the actuarial method, and also its rate. Also useful for the asset that need to be disclosed. Also the gross carrying amount, accumulated depreciation, impairment losses at the beginning and at the end of the period, as well as reconciliation of the carrying amount. That in short is the PPP movement schedule. You show the addition, disposals, asset held classified as held for sale, impairment losses and reserves of impairment. NB, the recognition of an item. Now, when you talk about the recognition, that's the removal of a PPE item from the financial statement. An item which has been previously been recognized in the financial statement is now being removed from the financial statement. And when can we recognize a financial asset? Or when can we recognize an asset? An asset should be recognized from the financial statement, one, on disposal. Number two, when that asset is obsolete. And number 3, when the asset has been fully depreciated. Good. Those are the 3 circumstances under which you should recognize an asset from the financial statement. Number 1 is on disposal. Number 2, when the asset is obsolete, that means the company expects no future benefits from that asset. And then when the asset has been fully depreciated. Then you have disclosure requirement for PPE stated at revalued amount. Yeah, for example, when you revalue an item, what are the disclosure requirements you need to show in regard to that? 1 is the carrying amount of the PPE. The carrying amount is the amount shown in the financial statement. Then the changes in revaluation surplus, that's the revaluation gain and revaluation losses. Disclosure of specific accounting policies and effective date of revaluation and whether the independent value was involved. Also, a reconciliation between the carrying amount of the revaluation surplus at the beginning and at the end of the period, i.e., indicating the movement balances. Good. Now, let's look at the financial instrument. And what's a financial instrument? Now, I want you to know that a financial instrument is just a contract giving rise to an asset to one party and a liability to another party. We're saying that is a contract giving rise to an asset to one party and a liability to another party. So, for example, if you buy a bond from the government, that means we're investing in the government bond. So to you, it becomes an asset, to the government it becomes a liability. If you issue a debenture, or you buy a debenture from a company, in that case, it to you becomes an asset, to the company becomes a liability. If you buy a share from a company, in that case, that share becomes an asset to you, to the company becomes a liability. If you take a loan from the bank, to the bank, that loan is an asset, to you it's a liability. Now that's what we call a financial instrument. How do we recognize and measure a financial instrument? Now, a financial instrument is a contract that gives rise to a financial asset to one party and a financial liability to another party. And under IAS 39, financial assets are classified into 4. We have financial asset at fair value, available for sale financial asset, loan and receivable, and we also have held to maturity. Now, held to maturity, an example is a redeemable bond or a redeemable debenture. It has a specific maturity period. Then, now, first of all, let me discuss on the first 2, financial asset at fair value. Now, financial asset at fair value. Now, financial asset at fair value, they are short-term financial assets. Therefore, if they are short-term financial asset or financial investment, therefore, they are recognized as part of current assets. Number 2, we have available for sale financial asset. Now, available for sale financial asset, they are long-term financial investment. So, therefore, by the virtue they are long-term, therefore, they should be recognized as part of our current assets. So, that's the difference between the two. That financial asset at fair value, they are short-term. Available for sale, they are long-term. Therefore, financial asset at fair value, they are current assets, but available for sale, they are non-current assets. Another difference is that financial assets at fair value, they are measured and recognized at fair value. But available for sale financial assets, they are measured either or they are recognized either at cost, that the amortized cost, or at fair value. And we say that the fair value simply means the market value. Yeah, I've indicated the measurement here. The financial instruments are measured either at amortized cost, yeah, that's just take the cost minus any amortization, or at fair value. So we have provisionally governing initial measurement and subsequent measurement of financial assets. And all financial instruments are initially measured at fair value. You need to know that all financial instruments are initially measured at fair value, plus or minus, in the case of financial asset or liability, not at fair value through profit or loss. Then subsequently, all financial instruments are measured either at cost or at fair value. Then we have requirement for the recognition of financial instruments. We say that this recognition is just removal of an asset which has been previously in the financial statements, then removal from the financial statement. Now, in this case, we're looking at financial investment. For example, assuming you had a share or you had a bond. And in this case, you are recognizing that an item in the financial statement as an asset. When do you recognize it? So, for example, for share, once you transfer the ownership, that means in short on disposal. So, on disposal of that financial instrument, you recognize from the financial statement. Number 2, it's upon maturity. For example, assuming you had a redeemable debenture or a redeemable bond. On maturity, that means the company ceases, or you as an individual ceases to receive the benefits from that asset. So that are the 2 requirements for the recognition of financial instrument. Good. So then we have impact of IFRS 9 on tax expense on commercial banks. Now let's go to impairment of an asset. What do we mean by an impairment of an asset? So impairment is more of a depreciation, but in this case, it's somehow different. Now, depreciation arises as a result of the usage of an asset. So, for example, if you bought an asset at the beginning of the financial year, at the end of the year, there is that loss of value as a result of usage. Now, that's what you call depreciation. Now, what's the difference between a depreciation and impairment? Now, for example, assuming you have an asset worth 1 million, that's the cost of that's the cost. The cost of that item is 1 million. Then that item by the end of the financial year has depreciated by 200,000. The depreciation is 200,000. The cost was 1 million. So that means how much is your net book value? So the net book value, or what you call the carrying amount of that asset, is 800,000. So by the reporting date, you know the carrying amount of the net book value of that asset is 800,000. Now, assuming you want to sell that asset, and you know its value is 800,000. But if you are to sell that asset, the maximum you can get from the market is only 700,000. But you know its value is 800,000. So that loss of from 800 to 700, that loss of 100 is what now we call impairment of that asset. Good. Or I give you another illustration. For example, assuming if you buy a new phone now, or let's assume today, if you buy a new phone today, for example, at 50,000, and then you decide on the same day, you just need to sell that phone. You have bought it at 50,000, the same day, then you decide to sell it the same day. High chances you may not get a buyer who will pay for that asset for 50,000, the initial purchase price. So you get that maybe the maximum you can get, it's maybe 40,000. Now, that decrease in value, that's what you call impairment. That's not a depreciation. Because number one, this asset is new, so you have not used it. That means that asset has not yet depreciated, but the value has just dropped. Now, that's what we call impairment. And therefore, an asset is said to be impaired if the carrying amount, the net book value, is greater than the recoverable amount, what we expect to recover from the market. Now, let's look at the indicator of impairment of an asset. How can you determine that an asset has been impaired? We have both external indicators and internal indicators. And one of the external indicators is that there is a significant decrease in the market value of the asset. Number two, there is a significant change with adverse effect. When you talk about the adverse effect, we're talking about negative effect. Yeah, when there is a significant change with adverse or negative effect to the entity's technology, economy, or legal environment. And then number three, when there is an increase in the market interest rate, likely to affect the discounting rate used for calculating the asset value news. Then we have internal indicators. One is the evidence is available of obsolescence or physical damage of the asset. Number two, evidence is available that indicates that economic performance of the asset would be worse than expected. Also, you can add another one, an internal indicator, evidence of internal inefficiencies. Evidence of internal inefficiencies. Good. Then we have borrowing costs. That's under IF 23 or IPSAS 5. And what are borrowing costs? Now, borrowing costs are the costs associated with borrowing of funds. So there are costs associated with borrowing, such as interest, flotation costs, that an entity incurs in connection with borrowing. Borrowing cost is directly attributable to the acquisition, construction, or production of a qualifying asset. So, for example, if you take a loan of 1 million, maybe to purchase a motor vehicle. Now, that motor vehicle is what we call a qualifying asset. Note that borrowing costs should be capitalized. Borrowing costs should be capitalized. Then, other borrowing costs are recognized as an expense, such as legal expense. So we're saying that borrowing costs should be capitalized. For example, if you take a loan of 1 million, you expect to pay back with interest, assuming the interest in this case is 200,000. The loan amount was 1 million. The interest you expect to pay is 200,000. In your financial statement, you don't show a loan of 1 million. You need to show a loan of 1.2 million. So that means that interest is what we call the borrowing cost, and that borrowing cost needs to be capitalized. Then other costs or other borrowing costs, such as when you're drafting that loan agreement, you engage a lawyer. There was some legal fee which was charged. Now that legal fee, yes, that's why you're talking about other borrowing costs. They should be expense. Expense, that means presented to the income statement as just an expense. So that's accounting treatment of borrowing costs. That borrowing costs should be capitalized, but some borrowing costs should be expensed. Good. So what are the examples of borrowing costs? One, we have the interest on loan or borrowing, flotation costs such as legal costs, principal amount, amortization of discount or premium relating to borrowing, and then exchange difference in case of foreign currency transaction. Assuming you had borrowed this amount in US dollars, and then you want to convert them into Kenyan shillings. So in that case, there might be that exchange difference, which is a loss. Yeah, we have exchange gain, we have exchange losses. So now that loss becomes as part of the borrowing cost. Good. What's a qualifying asset? As an asset that necessarily takes a substantial period of time to get ready for its intended use or for sale. And we have examples of qualifying costs, so we'll go through that. Then accounting treatment and recognition of borrowing costs. We have said that borrowing costs should be capitalized, but some expenses need to be expensed. Good. Then I have explained how the accounting treatment of IFRS 5. IFRS 5 is an international public sector accounting standard. 5 differs from IAS 23. So under IFRS 5 requires borrowing costs to be expensed immediately in the period in which they incurred, regardless of how the borrowing is applied. This is the benchmark treatment. But under IAS 23, the revised version requires that all borrowing costs that are eligible for capitalization should be capitalized and included as part of the qualifying asset. So under IFRS 5 expensed, under IAS 23, they should be capitalized. Good. Then we have provision, contingent liability, and contingent asset. That's under IAS 37, which is the same as under for IFRS. In case they ask about for IFRS, it's the same. Now, what's a provision? Now, a provision is a liability of uncertain timing or amount of event. For example, the way you usually look at provision for doubtful debts. Yeah, that's a liability. It's something you expected to receive, but in this case, you have no hope of receiving. Now, that's what we call a provision. Now, recognition of provision. Now, note that provision should only be recognized if probability of occurrence is more than 50%. That's when the provision should be recognized. If the probability of occurrence is less than 50%, it should not be recognized. Rather, it should be only be disclosed. So a provision should be provided and recognized as a liability in the financial statement when, number one, an event has presented obligation, has a present obligation as a result of past event. Then it's probable that an outflow of resources will be required to settle the obligation. Then a reliable estimate can be made of the amount of obligation. And also when the probability of occurrence is more than 50%, that's when we recognize a provision. Then we have contingent liability and contingent asset. Now, what's a contingent liability? Now, this is a possible obligation that arises from the past event and whose existence will be confirmed only by the occurrence or non-occurrence of a certain future event, not wholly within the control of the entity. I repeat again. Now, a contingent liability is a possible obligation that will arise from past events and whose existence will be confirmed only by the occurrence or non-occurrence. Now, for example, assuming you have a pending legal case. In this case, another company has sued your company. You being the company who has been sued, in this case, any outcome, we expect that in case the other party wins, you expect to pay damages. So in that case, that's what we call a contingent liability. And we are saying that whose existence will be confirmed only by the occurrence or non-occurrence. In this case, we cannot be sure or you cannot estimate the amount of damages the judge might award to the other party. So in this case, that amount should be recognized as a contingent liability. So if the obligation is probable, it's not a contingent liability. Instead, a provision is needed. So if you're probable, if you can be able to estimate the amount you expect to pay, in that case, therefore it's not a contingent liability, that's a provision. But in this case, when you are uncertain, that uncertainty is what we call a contingent liability. For example, assuming if you sell an asset and they give you a warrant, you give out a warrant. That means your customer, anytime from now, maybe if you give a warrant of 1 year, might come back, for example, for you to repair that item. Now, that is another example of a contingent liability. You're saying that whose existence will be confirmed only by the occurrence or an occurrence of a certain feature, of which has arisen from past events. Then you have a contingent asset, is the opposite. A contingent asset is a possible asset that arises from the past event and whose existence will be confirmed by the occurrence or non-occurrence of one or more uncertain future events. For example, in this case, you are the one who has taken another company to court, and in this case, you are the one expecting to receive the damages. So in that case, becomes a contingent asset. Now, note that for both contingent liability and contingent asset, they should not be recognized. They should only be disclosed. They should not be recognized. They should only be disclosed. Good. A contingent asset must not be recognized. Also, saying that contingent liability shall not be recognized, but shall be disclosed. Good. So in case you ask about the provision regarding to provision, contingent liability, and contingent asset, provision should only be provided if probability of occurrence is more than 50%. But for contingent liability and contingent asset, they should not be recognized. Rather, they should only be disclosed. Good. Then we have accounting policy changes and estimate. And these are specific principles, rules, and practices applied by the entity in preparing and presenting its financial statement. A change in accounting policy is only recommended when, number one, it's required by IFRS, or it results in financial statement providing reliable and relevant information about the effect of transaction. So those are the two major circumstances under which accounting policy changes is required or is advised. Number one, when it's required by IFRS. Number two, when its result of the change will bring a more reliability or increase the credibility and reliability of the financial information. Then a change in accounting policy shall be applied retrospectively. Now, retrospectively, that means that requires an entity to adjust the opening balances of the affected component of the equity of the asset. Now, in this case, if you're applying you want to change something in the accounting standard in this financial year. So remember the balances of this financial year, they were affected by the closing balance of the last financial year, because the balance carried on for the last financial year was our opening balance for this financial year. So in this case, when you talk about retrospective application, that means you need to adjust the opening balance of the affected item of the financial statement. Good. Now, what are the circumstances which an entity is permitted to change the accounting policies? We have said that number one, only when required by IFRS, and then number two, when the change results to a more reliable information, also to comply with the changes in the accounting standards, and then to comply with the changes in registration. Registration, that means because different countries have different registration. So in case there is change of registration, in that case, you might be rendered to change your accounting policy. Then we have event after reporting period, or what we call the balance sheet date. That's under IAS 10. Now, what are the event after reporting period? Now, if the financial year ends on that 1st December, now the company or the entity is given like it usually do have 3 months for them to prepare now the financial statement for that financial year. Now, for example, if the financial year ends on that 1st December, they'll be given, for example, that 1st December 2020, they'll be given a duration maybe up to that 1st March 2021 for them to present the financial statement and to convince an AGM. Now, that's what we call now event. Now, okay, that duration between the date of the reporting date, that 1st December, up to the date the financial statement are authorized for issue or just before the AGM, that's what we call the reporting after the reporting date, or what we call the balance sheet date. And these are events that take place between the balance sheet date but before the AGM. And there are two types of events. We have what we call adjusting events and we have non-adjusting events. Now, what's the difference? Now, adjusting events, they are those events that take place after the balance sheet date, providing additional evidence. So that's the key here, providing additional evidence of conditions that existed at the end of the reporting period. This event needs to be adjusted in the financial statement. So adjusting events, the events that happen after the balance sheet date, providing additional evidence of conditions that existed at the end of the reporting period. And this event needs to be adjusted to the financial statement. Example of adjusting events is bankruptcy of a debtor. If you have a debtor worth 50 million, and then this debtor has been declared bankrupt. In this case, when presenting the financial statement to the shareholder during the AGM, you need to adjust that amount of data, because number one, you cannot show the financial you are telling the shareholder that here we have a debtor who owes us 50 million. Well, knowing that this debtor has already been declared bankrupt, you have no expectation of receiving that amount back. So in that case, you need to adjust that amount. Also, recovery of a debt that has been previously been written off. Now, a bad debt that has been previously been written off should be recognized now as an income. Then sale of inventory. If in case you sell the inventory during that period, you also need to adjust your closing stock. Also, discovery of fraud or errors that shows that the financial statement are incorrect. Settlement after the reporting period of the court case that confirms that the entity had an obligation at the end of the period. Then we have non-adjusting events. Now, these are events after the reporting period that is indicative of a condition that arose after the end of the reporting period, which need not to be adjusted in the financial statement, in that they do not provide more evidence. For adjusting events, therefore they need to be adjusted, since they do not provide more evidence. And they include decline in the market value of investment after reporting period, a change in tax rate, not need to be adjusted. Destruction of a major production plant should be destruction of a major production plant, not just major production. Announcement of plan to discontinue an operation, as well as declaration of dividend after the reporting period. So what are the accounting treatment of subsequent event or event after reporting period? We have said that adjusting events requires amendment of the financial statement to incorporate them under disclosure of the nature of the subsequent event and the material of impact. So that means adjusting events need amendment of the financial statement, but for adjusting events do not require amendment to the account. That's the accounting treatment of subsequent events. Then we have prior period errors, accounting and disclosure requirement. Yeah, prior period errors. A prior period error is an omission or misstatement of prior period financial statement. Now, such error must have been caused by the failure to use or misuse of information that was available when the financial statement was authorized for issuance, and that could be expected to have obtained, e.g., mathematical mistakes, wrongful application of accounting policies, yeah, misinterpretation of facts and figures. So, what are the accounting treatment of material prior error? Now, prior period errors must be corrected retrospectively. And we have explained what we mean by retrospectively by adjusting the opening balance in the financial statement. Retrospective application means that the correction affects only the prior comparative figures. Therefore, comparative amount for each prior period presented, which contain errors, are restated, and current period amount are unaffected. Good. Now let's look at government grants. That's under IS 20. And what do we mean by government grants? First of all, you have to differentiate between a grant and a donation. What's the difference between a grant and a donation? Now, a grant and donation, you are just financial assistance from the government, but grant has some specific condition on it. Donation has no condition. So therefore, what's a grant? These are assistance or in form of transfer of resources to an entity in return for past or future compliance with certain conditions relating to operating activity of the entity. What's government assistance? Is an action by the government designated to provide an economic benefit specific to an entity. Government grant may be in form of an asset or an income. Then we have what we call forgive loans, and this is any form of loan from the government or organization which is entirely or proportion of it. The lender commits to forgive if certain conditions are met by the borrower. And what are the accounting treatment of grant? Now, there are two broad approaches at the accounting of government grant. One, we have the capital approach and we have the income approach. What's the difference between the two? Now, under the capital approach, these require grants to be provided out of P&L account. They should be recognized as part of equity or capital in the statement of financial position because no repayment is expected. Then we have income approach. Grants should be provided in the P&L as an income of one or more periods. So we are saying that in this case, when accounting for government grants, we have two approaches you can use. One is the capital approach, where the amount received from the government to be taken to the balance sheet. That means as a part of the equity or the part of capital. And then we have the income approach. For the income approach, the amount received taken to the income statement. Now, for example, assuming or the government has been bailing out Mumia Sugar. Assuming the government set aside 300 million to Mumia Sugar. Now, as an accountant or as a CFO, why do you think you should apply that amount? Is it using the capital approach or the income approach? Number one, when determining the approach to use, look at the amount and the magnitude. For example, 300 million, you cannot take it just to the income statement because in this case, the government is giving that amount for you to invest. For example, maybe to expand your operation, maybe to acquire more machines, to pay creditors, also to do some investments. So in that case, it should be part of capital approach. If you take it that amount to the income statement, that means automatically you might report a profit. If you report a profit, therefore the shareholders expect for them to get the dividend. And in that case, 300,000, that means you cannot present it under income statement. You should present it as part of the equity because you are given that amount for you to invest. Good. The circumstances under which government grants should be recognized in the financial statement. One, the entity should only recognize when the entity is certain that it will comply with the condition attached to them. Then number two, when certain about receiving the grant, and then when grant can be measured reliably, or the grant can be measured reliably. Good. Then we have non-current assets held for sale. Now, an non-current asset held for sale. For example, if a company has a motor vehicle is part of non-current asset. But in this case, the company has committed to sell this motor vehicle within the next one financial year or within 1 year. So that means if the company does not expect this company, this machine or this asset to be in the company for the next 1 year, therefore it ceases from being an non-current asset, it becomes a current asset. Therefore, it's a non-current asset. These are, non-current asset held for sale. These are assets whose carrying amount should be recovered from the sale transaction rather than through continuous use. It should be presented as a separate item under current assets. It's valued at the ROA of the carrying amount and recoverable amount. And current asset held for sale are recognized based on the ROA of both, based on the ROA of the cost or the carrying amount or the recoverable amount. What are the conditions to be met for an asset to be classified as a held for sale asset? One, the management is committed to plan to sell the asset. And how can you determine the measure the commitment? That means it's something, it's under their minutes, meeting minutes. Then number two, the asset is available for immediate sale, not the immediate use. The asset is available for immediate sale. Then number three, active program to locate potential buyer has been initiated. Maybe they have indicated this car is for sale. An active program to locate the potential buyer has been initiated. Then number four, the sale is highly probable within 12 months from the date it's classified as held for sale. Good. Then we have revenues. That's under IAS 18. And what do we mean by revenue? Revenue is the gross inflow of economic benefit during the period arising in the course of ordinary activities. Yeah, an income that you get from day-to-day operation, that's what you call revenue. Now, revenue includes only the gross economic inflow received or receivable by the entity on its own account. Now, amount collected on behalf of that party, such as sales tax, VAT, are not economic benefit and therefore excluded from the revenue. Yeah, remember the sales. Mostly if you get mostly for those and maybe supermarket, in the hotel industry, their revenue are always inclusive of VAT. Now remember, VAT is not your revenue. VAT is an amount collected on behalf of the government. So therefore, in this case, when determining your revenue, you should take the amount of sales. First of all, you deduct the VAT. The net sales is what you recognize as your revenue. Similarly, in an agency relationship, revenue is the amount of commission and the amount collected on behalf of the principal is not a revenue. Assuming you're acting as an agent, maybe for a rental house, you're acting as an agent. This means you are collecting rent on behalf of the principal. So the amount you collect from that building, for example, assuming you collect 1 million every month, now that 1 million is not your revenue. In that case, what you should recognize as your revenue is only the commission. For example, you're entitled to a commission of 10%. So you should take 10% of that 1 million, which is 100,000. Now that's your revenue. But the other amount of 900, it should be recognized as a liability because that amount does not belong to you, it relates to your principal. Good. Then revenue should be recognized if the following conditions are met. So we can go through that. Then we have other income such as interest, dividend, and royalties. Now revenue from the above sources should be recognized on the following basis. One, interest should be recognized using the effective interest rate method. That's the current market rate. Also, royalty should be recognized on an accrual basis. Then dividend shall be recognized when the shareholders have the right to receive. Then we have revenue from contract with customer. That's under AFRS 15. Now, AFRS 15 describes the following principal steps to be applied to all contracts with customer. One, those are the steps followed when recognizing the revenue from customer under AFRS 15. One, identify the contract with the customer. And the contract with the customer will be within the scope of IFRS 15. Yeah, and if the following conditions are met. One, the contract has been approved by the parties to the contract. That means that you have entered into an agreement. Then number two, each party has a right in addition to the goods or services to be transferred. The payment terms of the goods and services to be transferred can be identified. And then the contract has a commercial substance. So that's step number one, identify the contract with the customer. Then number two, identify the performance obligation to the contract. In this case, both parties need to know the obligation. What am I supposed to do? What are you supposed to deliver? In that case, you determine the performance obligation. Then number three, you determine the transaction price. That's why we say that the contract has a commercial substance. You have to be able to determine the transaction price. The transaction price is the amount which the entity expects to be entitled in exchange of the transfer of goods and services. Then step number four, recognize revenue when or as a entity satisfies the performance obligation, and then revenue is recognized as a contract is performed, either over time or at a point of time. Then we have inventory, that's under IAS 2. We'll go through inventory, how to measure inventory, and then disclosure requirement in relation to inventory. Then we have leases, that's under IAS 17. And this is a contract between two parties, where one party known as the lessor, that's the owner, gives another party known as the lessee the right to use the assets and enjoy the benefits and risk associated with the utilization of the asset. That's what we call a lease. So therefore, this is just a contract between two parties. One is known as the lessor and the one known as the lessee. So the lessor is the owner, lessee, the one using that asset. And we have various types of leases. One, we have an operating lease. Now, operating lease is just a short-term lease. Then we have a finance lease or capital lease. Now, finance lease is a long-term lease. Then we have sell and leaseback. Now, sell and leaseback, this is where you had an asset that you own, you have leased it out to someone else. Then you decide to sell that asset and you lease it back. So in this case, you cease to be the owner and then you become the lessee. And then we have a leverage lease. Now, a leverage lease is a lease with some financial obligation of standing. For example, if I buy a lorry and then I lease it out to you. But when I was buying this lorry, I had taken a loan from the bank. So that means you'll be paying me the lease rentals. Then that amount I use it to go and finance that loan. That's what we call a leverage lease. And a leverage lease usually have three parties. One is the lessee, lessor, and the financier. Good. What's operating lease? We're saying that these are short-term lease, and it has the following characteristics: that the lease period is very short relative to economic life of the asset. The lease contract can be cancelled by either party anytime before the lease period. Then the owner or the lessor incurs maintenance, operating, and insurance expense of the asset. Then the lessee is not given an option to buy the assets at the end of the lease period. Then we have finance lease or capital lease, and we say that finance lease is a long-term lease. These are long-term in nature, and the lease period is almost equal to the economic life of the asset. What are some of the characteristics of finance lease? The lease period should be at least equal to 57 and 75% of asset economic life. Then for long-term lease or for capital lease or finance lease, the lease contract cannot be cancelled by either party before the lease period matures. Then the lessee incurs all maintenance costs, and then the lessee is given an option to buy the asset at the end of the lease period. Then we have advantages of lease. You'll go through that. And then you also have the difference between a finance lease and operating lease. I'll say that one of the differences that for finance lease, it's a long term, therefore for operating is a short term. Then for finance lease, the lessee has an option to purchase the asset at the end of the lease period, but for operating lease, the lessee has no such option. Then for finance lease, the contract cannot be cancelled before maturity. But for operating lease, the contract can be cancelled anytime. Then for finance lease, the lessee incurs all the incidental operating expenses and account for the items in the financial statement. But for operating lease, the lessor incurs all the operating expenses and account for the assets in the books of account. Then you have sale and leaseback. Now, for sale and leaseback, this is a type of lease or financial transaction in which one sells the asset and leases it back. Therefore, one continues to be able to use the asset, but no longer owns it. It has the following feature or characteristic. One, long initial terms, and then it has triple net assets. Yeah, most sale leaseback are structured with a triple net asset. This means that the tenant takes full responsibility for the property each building. And we have the advantages of sale and leaseback. The advantage, the major objective is that sale and leaseback can provide the business with significant cash flow boost. Yeah, that's a fact. Also, it enables the business to realize cash or to raise cash from existing items of value such as equipment. The cash gain can be used to provide working capital. In case, for example, you have a machine worth 10 million. If I sell it to you at 10 million, then I lease it back from you, of which in this case, I'll only be required to pay a lease rent of 2 million per annum. You see, in this case, if I sell it to you at 10 million, then I lease it back from you. And in this case, annual rentals, I'll just be required to pay 2 million, 2 million, 2 million. Now, the excess cash, 8 minus 2, the 8 million I can use to finance my day-to-day operation. So that means it's provide working capital. And that also it provides the cash flow boosts. Good. Then we have, lastly, we have income taxes. That's under IAS 12, income taxes. And what we mean by income tax? These include all domestic and foreign taxes, which are based on taxable profit. Therefore, we have a difference between taxable profit and accounting profit. Now, accounting profit is a profit for the period determined using the accounting assumption. That's what we call accounting profit. But we have taxable profit. Now, the taxable profit is the profit for the period determined using the revenue assumptions. And we have allowable, disallowable, taxable, non-taxable, etc. Then we have what we call deferred tax. What do we mean by deferred tax? Now, deferred tax is the tax payable in the future, which arises as a result of taxable temporal difference. And we think that deferred tax, deferred, this is a tax payable in the future, which arises as a result of taxable temporal difference. Now, for example, if you had acquired a building at 100 million, the cost was 100 million. Then at the end of the, then after 2 years, you revalue that building, maybe to 110. The cost was 100 million, then you have revalued that building to 110. So that case, that means there's a difference of how much? There is a revaluation gain of 10. Now that 10 is what we call taxable temporal difference. That gain of 10, if you are to tax that amount, you will take 30% of the gain of 10, which is 3 million. Now that 3 million is what we call the deferred tax. It's tax payable in the future. Remember, in this case, we have not sold the building that you have realized 10 million. You have just made a provision. You have just made a revaluation. Now, that tax of 3 million, you will not pay it now. It's a tax payable in the future when you sell that asset. That's why it's called a deferred tax. It's a tax payable in the future, which arises as a result of taxable temporal difference. What do you mean by temporal difference? It's the difference between the carrying amount, the net book value, and the tax base of an asset. For example, assuming you have an asset worth 1,000. The cost is 1,000. Depreciation is 200,000. Then we have wear and tear of 300,000. Let me repeat my question again. I'm saying that assuming you have an asset, which is the cost is 1,000, depreciation 200,000. 200. Then wear and tear 300. How much is the net book value? Now, net book value as an accountant, you will take the cost minus depreciation, which is 1,000 minus 200, you get 800. Now let's go to the revenue authority assumption. Now that's what we call the tax base. The tax base, they'll take the cost. Depreciation is a disallowable expense, but they only provide for wear and tear. So we'll take 1,000 minus 300, which is 700. So the carrying amount of the net book value is 800, but the tax base, they are showing 700 because they have taken the cost of 1,000 minus wear and tear of 300. 800 now and 700. Now the difference between the two, there's a difference of that 100. Now that 100 is what we call temporary difference, and that temporary difference is what will give rise to deferred tax liability. Therefore, it's tax base. We'll go through what tax base. Then we have two types of temporary differences. We have taxable temporary difference and we have deductible temporary difference. Now, a taxable temporary difference, they are temporary difference that will result to a deferred tax liability. Deductible temporary difference, they are temporary difference that will result to a deferred tax asset. For example, we have said that a revaluation gain is a taxable temporary difference. If it was a revaluation loss, that's what we call a deductible temporary difference. Revaluation gain is an example of taxable temporary difference. Revaluation loss is an example of deductible temporary difference. And we're saying that taxable temporary difference, they are temporary difference which give rise to a deferred tax liability, but deductible temporary difference, they are temporary difference that will result to a deferred tax asset. Then we have deferred tax liability, is the amount of tax payable in the future. Then we have deferred tax asset. They are assets or they are amount of income tax recoverable in the future, which arises as a result of deductible temporary difference. But deferred tax liability will arise as a result of taxable temporary difference. Then we have the basis of measuring for current tax and deferred tax. Now, note that. Now, this one is preparing that for the next topic, okay, and the published financial statement. That the tax expense is made up of two elements. One is the current tax. Now, the current tax is just tax for the period. You take 30%. And then we have deferred tax. Deferred tax, you look at the provision. Now, an increase in deferred tax is an expense. Let me repeat again. Increase in deferred tax liability is an expense, where a reduction in deferred tax liability is an income. So we're saying that the tax expense for the period is made up of two elements. One is the current tax and the deferred tax. Now, current tax is the tax for the period based on the taxable profit for the year. But deferred tax, on the other hand, arises as a result of temporary difference. Now, increase in deferred tax is an expense, which increases the tax liability for the year, while a decrease in deferred tax is an income, hence reducing the tax liability for the period. Good. Now, that's what we have discussed about the assets and liability. You need to be very keen with that, because in your financial reporting paper, it carries between 25 to 35 months, and is a must. And everything we have discussed, actually, if you look at your past paper from 2015, actually not from 2015, actually from 2010 up to date, all the theory questions that are in that paper are actually what we have just discussed. So you just need to go through this. Have the first reading, have the second reading, and the third reading. You don't just go through it for the first time. It's something you need to have. You can make it a routine. It's just actually there are 9 pages. Imagine 9 pages. 9 pages. Go through the 9 pages. You can just also attribute every week once, every week one. Now for 3 weeks, this is something that should be at your fingertips. And then this topic also will prepare us in our next topic, that's published financial statement. Good. So that marks the end of accounting for assets and liability. Keep on revising.